Well, it's been a big few weeks in bond markets, so a few thoughts from us here at XTB on where we see this all going. Big news of the last few weeks has been the statement from RBA Governor Philip Lowe that the next rate move in Australia could be down. This is a pretty significant shift from where they were previously, that the next rate move would be up based on tight labour market conditions. And the market has really taken this and run with it. So we're now seeing in the futures markets 100% chance of one rate cut, so 25 basis points by October this year, and then potential for a further rate cut after that. We've got analysts such as Bill Evans from Westpac and Nomura forecasting 2 rate cuts, first one in July, second one in August, which is pretty aggressive. The market's really focused on GDP numbers now, and we saw that come out yesterday. So GDP numbers came out at year on year of 2.3 versus the RBA's forecast of 2.75. So pretty significant difference there, and you'd have to think that that leaves them further towards a cut sometime this year. Interesting survey also from Finder.com. So Finder.com surveyed 17 leading analysts in Australia. 15 of those are forecasting now the next rate move to be down sometime this year. Many analysts are focused on the property market. Property prices obviously falling around the country, particularly Sydney and Melbourne. UBS have really been leading the charge on this. So their view is that the wealth effect, or the declining wealth effect, will have a significant impact on consumption, which will lead to further rate cuts and potentially recessionary conditions in Australia. The RBA don't seem to agree with this at this point, and they see house prices falls as orderly, but that's yet to be seen. So on the back of this, we're seeing government bonds and corporate bonds rallying. So prices up, bond yields down. 3-year government bonds have fallen 20 basis points in the last month alone. So in this environment, corporate bonds have played out really nicely and been very well supported. Going forward, we see that market-driven events, so GDP numbers, employment numbers, will really be the key factors which are going to be driving corporate bond markets in Australia, and buying on the dips seems like the best place to position yourself in the next few months.